Thank you so much, everyone. Firstly, good evening and welcome to LVInsights. Basically, with LVInsights, what we are trying to do is we are trying to bring a series of interactive online AMA sessions for all of you, the Ask Me Anything sessions, if I may say that, for all of you so that we can help you better understand the trends of the ecosystem, where we try to deep down and have very deep conversations around topics like metaverse, gaming, fintech, impact investing, EV, D2C, health tech, and whatnot. Right. So welcome, and we look forward for all of you to joining us and learning and making more informed decisions around investing. Right. So today for our second AMA session, we have two of the most talented speakers with us, Sachindra, Rudra, and Shruthi, Cauvery, Iyer, where they will be helping us deep dive into the impact investment sector in India. Right. So welcome, Shruthi and Sachin. We are looking forward to this wonderful session. So let me quickly introduce all of you to our speakers today. So about Sachindra. Sachindra Rudra is a seasoned investor and has substantial experience into running and scaling organizations. He is an angel investor. He serves on the investment committees of 3 venture funds and works actively with several early stage enterprises. He has wide sectoral experience with a focus on consumer products, healthcare, renewable energy, and skilling/education. Before founding CaHa Capital, he worked for Acumen, which is an impact-focused venture capital fund in New York and Mumbai. Prior to joining Acumen, he was an investor with Navis Capital, consulted with McKinsey and Company, and led operations and strategy at Piramal Healthcare. He started his career with HUL. So welcome, Sachin. We are really looking forward to your session. Talking about Shruthi, so Shruthi is the co-founder and managing partner of CaHa Capital, which is an impact investment advisory based in Bangalore. She also manages Wharton Alumni Angels as the South Asia Managing Director. She is an active angel investor and currently oversees the expansion strategy of 2 early stage companies. Prior to this, she worked with an Israel-based healthcare venture capital fund while helping them setting up their India presence and raising their 4th round. Right. So welcome, Sachin and Shruthi. We are again looking forward to your session and learning a lot from it.
Thank you. Thanks for having us.
Thank you.
Okay. So let me just quickly let you know how the coming 60 minutes are going to look like. Right. So we have a very short presentation for all of you so that we can help you understand impact investing a little better with some of the case studies that will definitely help you understand it. We also have some set of curated questions that we have already received from the attendees. And during the end of the session, we will also open the stage for audience Q&A. Right. So I would request all of you to please, you can share your questions directly into the chat box. We will pick them up right after the presentation. Right. So let me just quickly welcome Shruthi and Sachindra to carry the stage forward.
Thank you so much, Anshul, for that introduction and setting the stage. I'll dip right into the presentation. I think the idea is not to spend a lot of time on the presentation, but more on the interaction with the participants. But as you pointed out, it's always good to sort of set a base. And I'm going to try and do that. And then Shruti is going to follow it up with 2 live examples. You can move to the next slide. So, I mean, I've sort of, been in the impact investing space for about 13 or 14 years now. And one of the questions that used to always come to my mind was that, does the world really need impact investing? Now, on the left-hand side of the slide, you can see the number of problems the world is facing. There's things like poverty, there's there's a lot of specific needs like sanitation, water, health, and then there are some sort of looming issues, which is unemployment. For example, youth unemployment in many parts of the world, including India, is really becoming a big problem. And many of these are actually summarized in what are called the SDGs, which is something that the UN put out a few years ago as 17 goals which the world should be heading towards. And at that point in time, a lot of analysis was done. And the analysis was also focused on what are the resources available. Now, you would expect many of these problems to be solved by the government. We all pay taxes, And we are all like, yeah, taxes should be solving the climate problem, or taxes should be providing clean drinking water to people. But as you can see on the right-hand side of the page, out of the $3.9 trillion which are needed to meet the SDG goals, and the SDG has a date of 2030 by which it's trying to meet many of these goals, only 1.4 trillion is currently committed to these goals from all sorts of sources. So whether you take tax dollars, whether you take the money the World Bank has, whether you take what's available from other international organizations, it's only 1.4 out of 3.9. And there is the blue bar, which shows the gap of $2.5 trillion. So more than half of the resources which are required to meet the strategic development goals don't exist today. And therefore, as you can see at the bottom, all these entities, all the way from governments, which is on the right-hand side, all the way to high net worth individuals, need to work towards meeting this funding gap. And truthfully, what is done by high net worth individuals, institutional investors, corporations, is what forms a large part of what we call impact investing. So the bottom line of this page is there is a huge gap in meeting the world's issues, and impact investing has a tremendously important role to fill that gap. And yes, therefore, the world does require impact investing. Moving to the next slide. So here, this is a slightly complicated chart, but I'm going to try and tell you what is impact investing. So there is a definition which is taken from the Global Impact Investing Network, which is on the left-hand side of the page. And I think a few words sort of must be highlighted on this definition. The first is that these are investments. So impact investing is not charitable giving. It is not sort of resources which are put into in kind. These are actual investments, much like venture capital and private equity makes investments. The second word, which is very important, is in the third line, which is the intention. There has to be intentionality in impact investing. It's not something which just happens automatically. It's not something that you do and suddenly you find, oh, there's been a positive impact. There has to be an intention. And the third part is the balance between positive and measurable social and environmental impact and financial return. So some people get confused. And they are like, oh, so impact investing is not looking for a return of capital or a financial return. The fact of the matter is, it is. But along with the financial return, it is also looking for positive social and environmental impact. Now, on the right-hand side of the page, you see this somewhat complicated grid. There is the expected financial return on the vertical axis, and there is the approach to impact on the horizontal axis. So if you are only interested in financial returns, you get the financially motivated investment. If you're willing to go for a complete loss of capital, then that particular project lends itself to philanthropic grant making, which is typically the way not-for-profit or NGOs operate, where they take philanthropic grants and they have an important role in things like disasters, or when there is a serious problem. Impact investing are the two green boxes, where there is intentional impact, which you can see on the horizontal axis, and where you are looking to make a rate of return. That rate of return could be a market rate of return. That rate of return could be slightly below a market rate of return. And those two green boxes are what is called impact investing. So I think what is important to remember is impact investors are looking for a rate of return, a financial return on their investments, but they are also very intentional about the positive social or environmental impact that they want to make. Next slide. Now, this is just giving you a sort of sweeping overview of what's been happening with the impact investing market. The first point to note is that impact investing in the last 10 to 15 years has become a hugely important financial segment. There is $300 billion, which is the assets under management under impact investing. Remember, this is very small compared to the gap that we were showing on the first slide. This is also very small compared to the $3 trillion, which is in the private equity and the venture capital market. So the $300 billion number looks very big, but actually, if you compare it with the need, and if you compare it with even the private investing market, it's actually quite small. But one of the things that you can note is the 16% growth worldwide. So this is a very, very rapid growth rate. The world economy is growing in low single digits, in 3 to 4%. Even an economy like India has been growing at 7 to 8% per annum over the last decade. The impact investing market is growing at 16%. The second point to note on the world market is that impact investing is no longer just a small market where small venture capital players are playing. They have a very important role. But given the need and given the importance of this market, Bain Capital, BlackRock, Goldman Sachs, all of these big fund managers have launched some form of impact investing work. And that can sometimes make a small investor feel, hey, I'm not needed. If BlackRock and Goldman Sachs are doing impact investing, what's the need for an angel investor? What's the need for a small venture capital investor? And I would argue that that's exactly wrong, because Bain Capital, BlackRock will now fund what are successful markets in impact investing. Financial inclusion, to an extent climate change. But when it comes to the deeper problems of the world, the start has to be made by high net worth individuals, by angel investors, by people contributing to smaller initiatives like the ones that Let's Venture runs, for example, because that is where the powerful examples are created, which in a weird way, Goldman Sachs and BlackRock will follow later. So the initial creation of the financial inclusion market or the climate change market was actually done by small impact investors, small angel investors, high net worth individuals. And once those markets started succeeding, and once they started giving returns, that's when a Bain Capital or a Goldman Sachs has crowded into the market. So there is a hugely important role for the kind of investors which are on the Let's Venture platform, for example, to actually contribute to impact investing. Very quickly, just summarizing for India, it's a $5 billion set of investments which have been made in the last 6 years. So that's quite a substantial sum being put into impact investing, in India. 14% is the growth rate that India is seeing, so pretty close to the world. A very, very important number over here is the weighted average internal rate of return. 11% is what impact investing is returning in India on average. And that compares actually very well with the rate of return, which is being earned on mutual funds, on stock market investments. And it is higher, as most of us know, than the 5 to 7% which you typically make on debt. So it's actually a very, very vibrant market, which, like I was saying, is focused on financial return, and the fund managers have been doing very well there. And look at the number of people positively impacted. 60 to 80 million annually are the people who are being positively impacted by what's being done by the impact investing fund managers. So again, I think India has done well. It's a good balance between positive impact and financial return, which the fund managers have been giving. And that's one of the reasons why the market is growing at 14%, because obviously people are quite excited to participate in it. Next, I'll very quickly take you through sort of my 5 learnings from my 13 to 14 years in the market. Firstly, I think impact investing, and especially, calling out all the entrepreneurs who run social enterprises, which are actually the core people who are making a difference to the world. It takes a lot of passion. It takes a lot of grit and resilience, because people fail. They have to, dust themselves up, get up again, and keep trying to solve the problems which exist in the country. And it takes some tears. So truth be told, it's not an easy place to operate in. And social entrepreneurs are doing, I think, a tremendous job, and they need the support of everybody to actually continue to do the work that they do. And venture capital funds in the impact space, high net worth individuals, family foundations have, I think, a tremendous role in helping the social enterprises and the social entrepreneurs do that work. The second is, people often ask me that how do you ensure that, an enterprise will have impact? And how do we ensure that a social enterprise will not become money-minded and want to become a unicorn and want to buy, I don't know, a Maybach or a very expensive dining table, or what some entrepreneurs have been, I've been reading in the press, have been doing outside of the impact space. And the most important thing to look for here as an investor is whether impact is built into the DNA of the enterprise. So when I used to work for Acumen, one of the most important things I used to look for is, are these people talking about impact because they are talking to me and I work for Acumen, which is an impact investing fund? Or is there true passion and in the DNA of the company is making the world a better place, deeply a part of it? So I think that's very, very important, that it should be built into the DNA of the company. Which kind of brings me to my third point. The number one diligence item for an investor in the impact space is the management team. Yes, the business idea is important. Yes, how it's going to have impact is important. But the number one thing is the management team itself. And there are 2 reasons or 3 reasons for that. One is impact in their DNA? Do they truly care about the beneficiary that they are talking about? It could be low-income consumers. It could be, climate. It could be bringing water and sanitation to people who don't have access to it today. Do they really care about it? The second is that in the impact space, there will be failure. There will be success. There will be, there will be all kinds of situations. Does this management team have the resilience and the grit to work through that? And then the third is that, do they have a business mindset? Are they looking to give financial returns to the investors? Are they looking at sustainability? Do they look at the cash flow? Or do they have a mindset that, oh, the money will keep coming and I just have to keep doing whatever I'm doing, which is not the mindset I as an impact investor look to. The fourth point is very important. Measurement is the key to success. I mean, there is the old adage which says what gets measured gets done. And impact is difficult to measure, and we can talk a little bit more about what are some of the techniques to do it. And the last thing, which after 14 years I have been convinced about, and I've spent another 12 years in the pure corporate sector before that, is that impact investing will create lasting change. And I think all of us, if we put our shoulder to the wheel, if we put resources, if we support the social entrepreneurs, 20, 30 years later, this world will be a much better place for the work that's been done. I'll stop there and pass it on to Shruthi.
Thanks, Sachin. We're going to move into the case study part of our AMA session right now. And the idea behind the case studies for us was to, introduce people here to 2 deals that may look like, a regular sort of deal that has come to you and you're evaluating on the basis of, hey, is this a company I believe in? Is this a company that I should be investing in? And once I present each of the case studies, which will be on a no-name basis, we could talk about, do you think this is a good investment? And if yes, why? If not, why? So the first company that we wanted to present is a very impressive, first of all, and we had seen the founder through, his journey of building this healthcare platform, because he unfortunately lost his mother due to a doctor's negligence. And he felt that if only he had been able to, book a doctor's appointment and get his mother the care she needed, things could have been so different. And in the place where he lived, there did not exist at that point of time any telehealth services, so to speak. So he went about building this venture, initially starting off as a company that takes actually phone calls to book a doctor appointment, post which the doctor actually is assigned to your case and then visits you in your house. And can do like a routine medical checkup, can administer vaccinations, and whenever necessary, refer you to the nearest primary healthcare center, or if required, to an emergency healthcare center. Phase that they decided to build an app and go the whole tech startup route. And that is exactly what they built out to do. And they realized that even though till now they were profitable despite being a bootstrapped company, they would not be able to scale the way they wanted to. They would not be able to like take this product to 7 different regions versus being based out of one city. And that is when they approached us to help them raise a round of funding in order to hire key people in CXO positions, because it was a single founder company, in order to build the tech back end, as well as a good team to do the front end, and to sort of help with your exponential growth and operations. And we really liked the idea, and we really also liked the reason he started the company, and we really liked the impact that the startup was already generating and would be able to generate in the future. Like I mentioned, both these case studies are, a presentation to you. And I don't know if there is a way to engage with the audience here, but I would like to know, based on the limited information sort of presented here, do you think this is a good investment? Is this something you would invest in, of course, subject to more like due diligence and asking more questions? Or do you think this is an impact investment that might generate very high impact returns, but probably will not produce the financial returns you're looking for, which I would, address sufficiently if you do raise that concern. So Anshul, please let me know if there's any questions or sort of any response on the chat box as to whether this would seem like an interesting opportunity to all the future investors here.
Shruthi, what we can do is we can just take a raise of hands for who think that they would invest into this particular startup. So we already have Dheeraj who is ready to invest into this particular startup based on the information that he has. So I would request all of you to please just give us a raise of hands if you are willing to invest into this particular startup. You can take 10 or 15 seconds to just go through it and give us a raise of hands if you are willing to invest. Yeah, so we are getting comments like we need a proper, a good analysis out of it. So we are very sure that definitely analysis is important. But based on the limited information, as Shruthi mentioned, that based on the limited information and what Shruthi has explained so well, we would just wanted to understand whether, owing to this, would you invest? Again, after that, you will definitely get much more information whenever deal comes.
Yeah, I mean, I would position it as, I saw a few comments that I think Richa says, I don't think this is an impact investment. And then I see other comments that say, we need more information, we need to know the growth trajectory. And I think the important thing to point out here is this is an investment. And this is how you sort of, start asking the right questions. You start thinking about diligence. And then you say, okay, I think I'm willing to get behind this idea. And by the way, this is a company that's very high on impact. And Richard, to your point, the way impact is measured is, again, it's a big topic, and probably this session will not let us cover it to entirety. But one way that we have on our advisory side used is to see if a company meets or is able to meet the criteria of certain SDG goals. For example, gender equity. For example, better healthcare. For example, education. And that is a way for us to track, impact in a very sort of general sense of the term. Of course, when we are looking at, is this a company that's going to generate massive impact? You're going to talk about how many lives will they be able to, positively change in the next X number of years. What is the impact generated per dollar amount, for example? So like I said, that is a huge topic. And sometimes potential startup investments that look like a regular investment are in fact impact investments. And this is a general bias that we have encountered. And we have heard quite a few, even sometimes seasoned venture capital investors saying, we don't do impact investment because we don't think impact investments will generate the kind of returns we want them to produce. And that is not true, because it is an investment, and the added benefit is it is capable of producing massive amounts, massive impact as well. I'm sorry, I think there is another comment from Richa, but any questions regarding this company, happy to address. And now that we've spoken about it a little bit, I'd like to give you an overview of what exactly happened. So like I said, we really liked everything about them, and we really felt that they were ready to raise a round in order to sort of, grow to the next stage. They were indeed successful in raising a seed round. And a lot of the investors we spoke to in order to raise capital for them were impact investors, but also traditional VCs. And we received a similar response from, both sets of investors. So I hope that helps. Okay, so the next company is actually a podcast company. And here again, I'm just going to present it to you, and without really sort of giving away much about, what we did with them, and, whether they should be raising an investment at all, and do you think they're even, worth a second look, etc. So what we really liked about this company is that they were building educational content for kids between the ages of 3 and 11. And the problem that the founder identified is that kids are, always in front of the TV, they're always in front of screens. There's so much video content going around, and it is not necessarily educational, so to speak. And he felt that if there was audio content and educational content, kids would be willing to engage with that content. Parents would be much happier. Hopefully it would reduce the behavioral problems and tantrums. I'm not so sure about that. And he himself has 2 children between the ages of 5 and 7, and had worked as a media exec for a number of years. And when he lived in the UK, before he started this, his kids always sort of, used audio podcasts. And when they moved back to their hometown, the kids were constantly watching CoComelon. And I mean, if you have kids, you know what I'm talking about. And so we really like, building a company when you identify a problem and really believing that you can find a solution for that. And the company, has massive engagement. They have more than 47 podcasts that are being sort of aired on a weekly and now a monthly basis. The reach is exceptional because they partner with several sort of radio channels, And so therefore, it's not just your urban population that is engaging with this content, but also, kids in tier 2, tier 3 cities, anyone with a radio, and anyone with a phone even, right? And they have certain classes, as you call them, to teach children like English words. Like there is an English vocabulary class or an English vocabulary podcast once a week. There is a history podcast once a week, which talks about like Indian history. And I really, loved that they were putting so much focus on, helping children also have access to local content, because again, like even with like adult podcasts, like most of it is like made in the West, and then we just like consume it in here, which is fine for us because the world is global. But then they had this focus on giving kids in India, content about India, educating them more about India, and they also managed to get on all the popular sort of networks: Spotify, Apple Podcasts, Amazon Music, Ghana, you name it, and they're there. And we saw the engagement rates sort of like going high on a weekly basis, on a monthly basis. And we thought they were doing a good job. Now, I may have like, given them a very, like a good 5-star review, but we really felt that it was a growing segment, and then there was a true need for what they were building. So based on this, again, limited sort of information, what do you think? Do you think this is an investable opportunity? What do you think about the impact perhaps as well?
There's just one question, Shruti. So Sangeeta wanted to know, from where does the company make money?
Okay, good. So Sangeeta, they currently had only one sort of revenue source, which is that because the engagement they have and sort of the audience they have close more than 100,000 listens every month. They have brand sponsors, and in the future, the idea is to build a subscription model as well. So, for example, a Johnson & Johnson will be a brand sponsor in exchange for sort of advertising on one of the podcasts, like during one of the podcasts, etc.
Awesome. Thank you so much, Shruti. I would request all of you to again use the raise of hands option for just letting us know whether would you like to invest in such a startup based on the impact that they are making. So yes, what do you guys think? Would you like to invest in this particular startup? Just a raise of hand would do. We got Aniket, we got Crystal, we got Richa.
Okay, great. So I mean, I can. Well, we already know what happened with them, so I can give you a brief overview. So even though they are like very high on impact, and we really felt like they were in the right segment, etc., they were not able to solve their revenue problem. And part of that reason was like, yes, brand sponsorships were coming in, but like at a much slower pace than they anticipated. And they realized that, subscription model is still like a very sort of tough sell because a lot of parents are very happy to consume like free content. But when it comes to like paying like 120 rupees or 150 rupees a month, a lot of them will back out. They are still going strong. The only problem they have faced is that, their revenue numbers are not looking very good. For someone who has such high engagement, so many listens a month, so many people following them, they still haven't figured out how to solve the revenue problem. So again, even though it's like a great company producing massive amounts of impact, we had to sort of pass on them finally because we did not see them as an investable opportunities, so to speak.
Got it. Thank you so much, Shruti and Sachin. So I think so these are the case studies that we had. And thank you so much for such an insightful session, I would say. We would probably just, rather than me dilly-dallying here and there, I would just get into the questions quickly. So one of the questions that we got from Rudra was, how do founders of social enterprise make money for their living? Like, for example, say on per salary or per equity basis, what? So any one of you can just take the question.
Sure, maybe I can start. I don't think it's it's different from any founder of any enterprise. I think the starting point is that most founders of enterprises, social or otherwise, actually typically put in money into their companies, which is often called bootstrapping. Sometimes they take money from friends and family during the formative stages of an enterprise. After that, I think as soon as you have a first round of funding coming in, and especially as you move to the first round of institutional funding, most investors completely would like the founders to be taking a reasonable amount of money, to be running their lives. Because I don't think investors are, they recognize that there are children, there are families, there are houses, and those have to be run. And an unhappy founder is not something that any investor wants. So a certain amount of salary, if you want to call it that, is something which most investors would be very happy. And I often, when I'm investing, want to make sure that the line item of the salary of the founders is correct in the P&L and the projections of the company, rather than founders telling me, no, we don't need any money for the next 4 or 5 years. I don't think that is a sustainable proposition for any company. But it is true that that a substantial sum of the compensation of founders can often be from the sale of their stake in the company in the future rounds of funding. So by the time you reach sort of Series A, B, C, you start finding that the company has, if it succeeds, of course, has become much more valuable. And as investors come in at that point in time, and in some companies, which are many companies which I've invested into, along with the primary infusion of, say, X million dollars, there is also a secondary. And as an investor in those companies, I often encourage incoming investors to tell them to buy a small secondary stake from the founders, so that they have the kind of money which is required, for example, to buy a house or to send a kid to, college education or something like that. So that's the way the trajectory works. But it's truthfully, I'm sure it's the same for every startup. Except for very few which get funded very heavily very early on. For most startups, even if you look at the original Flipkarts and the Zomatos and the Swiggis and all of the world, they started off by friends and family rounds, bootstrapping early on, then getting a reasonable amount of money when the first funding came in, and then obviously, getting substantially larger sums as the Series B, C, D, E's went through those companies.
Understood. Thank you so much, Sachin, for that. I hope that answers the question. So I would also like to ask one more question. So Shruthi, I would like to ask you this question. So I know that we have spoken about sectors in which we can, as an impact investor, we can invest. But can you just deep dive a little bit into what are the three kind of sectors, like various sectors where investments are made, for example, say sustainability or ESG, etc. So yeah, let us know.
Yeah, thank you. One thing, we have been reading a lot about is that people who said, I'll only invest if it makes sense financially, when they started reading about climate change and all the disasters around the world, immediately took action and then started sort of diverting some of their capital into, climate change and, organizations that are trying to tackle climate change. And so we feel like climate related, themes are like heavily funded at the moment. Also, education is something that gets, a lot of support from investors and impact investors alike, fintech as well. And also a lot of investments in health and wellness is what we are able to see regularly. And, what helps is that all of these sectors are able to leverage technology, right? Which is one of the most important aspects of becoming a venture capital backed sort of startup, Because otherwise, if you're trying to, apply solutions in a brick and mortar kind of solution, like, for example, somebody has primary healthcare centers, maybe they have, 100 primary healthcare centers, and it is a really important, gap that they're able to fulfill for that market. But it is very hard to scale, right? If you have to go and build like one more center here, one more center there, and those kinds of organizations are very hard for investors to see returns in as well. But thankfully now you're able to apply technology to all these problems. Obviously in the climate space, the application of technology is slightly different, right? Because there we're talking about innovation in battery, how batteries are charged, how long they can last, what are the hub and spoke models, etc. But there is a strong sentiment of, oh my God, our planet is exploding and I need to do something about it. Yeah.
Got it. Thank you so much, Shruthi. Definitely got that. Climate is one of the most important as we move forward for education as well, right? We also have one more very interesting question from Dheeraj, which states that it would be nice to know how do founders reach out for fundraising. So if you can just share some light on that, Sachin, maybe, yeah.
Yeah, I think, I think there are various ways. So one of the early ways for, I think, founders to reach out for funding is to find people in the world, in their networks, who are interested in a particular issue. So if you're interested in, if you have a startup which is in the, say, it's like the podcast startup which Shruthi was talking about earlier, you're looking at educating, kids between certain ages, then you look for people who are interested in children's education. And who've been doing work over there, who have who attend seminars, who attend webinars now with COVID in that space. And I think those are great people to reach out to initially. Sometimes I think in the initial stages of a social enterprise, a person-to-person connect can work very well, right? Then I think once you start reaching the institutional stage of raising impact investment, then both in India and internationally, you have very good directories of impact investors. So the Global Impact Investment Network, what is often called the GIN. In India, there's the Impact Investing Council. These have good directories of who are the impact investors. There is also information typically available on which sectors they're interested in. There's also information available on what is their ticket size. Do they do $500,000 or $2 million? Which stages do they do in? So I think based on that, it makes sense to then curate a list, which is maybe 5 to 7 funds, which would be interested in the kind of work that you're doing, and then approach them. I have typically found that impact investing funds are typically very open to having that first conversation, to seeing, what the entrepreneur is up to. And organizations like CaHa Capital exist, in fact, to help social entrepreneurs, put together business plans, put together financial models, which can then be taken to institutional investors like Acumen Fund, or like Omnivore, or like Low Capital, or like, Capria and others. So that's the two sort of things I would tell a social entrepreneur. Do try and find somebody who is interested in your issue. And then when you are ready, go in front of a curated set of 5 to 7 funds, rather than send off like 53 emails on a Tuesday morning, because, the response rates from that can be somewhat disappointing for entrepreneurs.
Got it. Yeah, thank you so much, Sachin, for such a detailed answer. Also, I would like to ask you this question. So again, we got this question in the chat as well. Can you just share some light on the exit criteria for social enterprise, like either being getting acquired by commercial enterprise? So because so the question is, if they are getting acquired by a commercial enterprise, then it might happen that the focus of impact may get diluted, right? So can you just share some light on exit criteria?
Yeah, absolutely. In the work that I've done, at least, there is always that risk. So that, that it goes away. However, Let me give you not a live example, but an example from my previous work. So we used to, Acumen used to invest into a health and wellness sort of enterprise, which Acumen held in its portfolio for 7 to 8 years. And this used to provide, prenatal, neonatal, and childbirth services to low-income consumers. And they were able to do it at that point in time, which was 5 or 6 years ago, at a price point of about 30,000 rupees for a C-section delivery and about 17,000 rupees for a normal delivery. The typical private sector rates for the same procedures were about 50,000 rupees and about 35,000 rupees, so near double. And this company actually got taken over by what is a very well-known hospital chain in the southern part of India. And I won't name it for confidentiality reasons, but it got taken over by that. And we were concerned that what if they increase the price to 50,000 and 35,000, what will happen to the impact? And the founder of the chain that, took it over said, I will never change the pricing of your hospital chain, because the fact that you're able to make a good gross margin and a good EBITDA margin, providing the service at those price points is amazing. I could never do it. And the fact that you can do it means that it's amazing. So remember the point I was making earlier, Anshul, whether the DNA, the price point and the margin structure was so deeply embedded in the DNA of the hospital chain that Acumen was invested into, that we were quite sure that even if we give it away to a higher end hospital, that DNA for this will not change. And the promoter of the high-end hospital confirmed that. He said, I would never change anything that this hospital is doing, because it would be very stupid of me to take a model which is so successful in a different consumer segment and change it. Investors who are impact investors often also look for that alignment when they are exiting. So Acumen and other investors will see they will not just sell it to somebody who's going to change the whole business model and make it only for rich customers, or not to have a climate change focus. So that is an exit consideration again. The third one is that who can really put resources behind this idea? Because an early stage impact investor will sometimes be able to put $1, $3, maximum $5 million. But some of the companies that I had invested into in climate change have raised $70, $100 million later. So it's important for the idea to scale, so that instead of 10,000 people, 10 million people can benefit from the work that the company is doing. And that will require newer investors with bigger pockets to come in. So I think people who will keep the impact going, people who see the value of what's been created by the social enterprise, and people who have the resources to put behind, whether it's a company or a private equity venture capital fund, are the three sorts of criteria that you typically look at.
Sure. Thank you, Sachin. That really helps a lot, I would say. Shruthi, I would like to ask you one more question. So basically, we got a question from Shilpa saying that, okay, what is the usual timeline an impact startup has to view to generate financial returns?
Yeah, I think it's sort of part of the overall question that, what kind of returns are, impact investors expecting, what is the tenure, etc. And there's actually a global impact investing network survey for 2020. And if I remember correctly, about 70% of investors expect, market rate returns. And in terms of tenure, we have seen, funds that are saying, tenure with like a possibility of like 2 1-year extensions. Because, we do believe that you need to be a little bit more patient. And of course, Jacqueline Novogratz, who is Sachin's ex-colleague, really coined the term patient capital. But we feel like that sort of patience is required, and most impact funds, when they're raising their own sort of GP funds, will say like a 10-year tenure with a couple years of extension as well. And so I think that would be a reasonable horizon to look for. But in terms of what investors are expecting, it is market rate returns. And surprisingly, even though some impact funds may have a longer sort of horizon, again, the same survey, I think, found that about 90% of impact investors were extremely happy with the sort of the financial performance and the impact performance of their investments.
And yeah, just to maybe add on to that answer, Anshul, at a company level, I think any impact investor, especially of the institutional type, will clearly look for a path to profitability. And they don't expect it on day one. Because as we very well know, no startups typically are going to be generating cash or from day one. But the path to profitability needs to be quite clear. The entrepreneur needs to be clearly to clearly explain to the incoming investor that I want these 4 things to happen in the next 9 months, 12 months, 18 months, and if those happen, then I will be able to be sustainable. I might not be making a huge margin, but I will be, cash flow positive. Those are the sorts of things I think investors are looking at, rather than are you already making a lot of EBITDA margin, which I don't think people expect any kind of startups, leave alone impact startups, to make. But also, if like to Shruthi's point, if like 5 to 6 years after the investments, you are still bleeding cash, then the incoming investors will be worried. And they will really wonder whether this enterprise is ever going to become cash flow positive, whether they are ever going to be able to make a financial return on it. So you might raise the seed round, like the $500,000, which the health tech company Shruthi was describing in case 1. You might be able to raise $500,000, but if 6 years later there is still no clear profitability coming from any of the lines that he or she is promoting, then you won't be able to raise the next $2 or $3 million.
So, got it. So thank you so much, Sachin, for that. We would probably take last 2 to 3 questions maybe, and then we can wrap up the session. We got 2 questions here which were probably very similar. So in Indian large corporations, they have this CSR mandates, right? So can the investment into impact would come from this CSR funds or not?
So at the moment, I mean, there is no easy answer to that, because the CSR regulations surrounding what corporates need to do is changing, evolving. I think even the government of India is fully trying to understand what do they want done with the CSR. When CSR started off initially, it was not allowed to be put into anything which sounded like an investment. It was meant to be what I was describing in one of my charts as philanthropic grant giving. Where you could give it for community development or something, but you couldn't buy shares. So you couldn't actually invest it. However, very good organizations like the India Impact Investing Council have made representations to the government of India, saying that impact investing is actually the best example of creating sustainable good in the world. Because once you create an enterprise which is doing good in the world, the enterprise will continue forever. While if you give a grant to an organization, once the grant finishes, then the good that is happening also kind of finishes, unless they can raise further grants. So I don't think the Impact Investing Council is arguing that you should only be doing impact investing, but I think they have represented to the government of India that it would be good if a certain amount of money which is coming out of the CSR can go into impact investing. And I think it's good. Like even for individual investors, Anshul, I'm not suggesting they should put all their money into impact investing, but I'm suggesting you do startups, you invest in the stock market, you buy fixed deposits and gold deposits, but impact investing should be a part of your portfolio, because today the trend of earning returns and doing good for the world is everywhere in the world. And so many people from, Bill and Melinda Gates to Jeff Bezos to other people are doing it. And I think all of us should also, make impact investing a part of our portfolio. So hopefully that works for the CSR fronts from the corporates too. But the government is still to let that happen, truthfully speaking.
Understood. Thank you, Sachin. I'm very sure like after this session, most of us will have that one impact startup into our portfolio as well.
Look forward to that.
Another question maybe. So This one is from Chaitanya, where he's saying that, okay, as an individual, uh, uh, there might be individuals with large investments on the direct cap table of the enterprise that can contribute as an SME, right? So, what is the difference, if I may, let's do this as a basic question. What is the basic difference between impact investments and doing investments through angel platforms like Let's Venture or any other platforms like this?
Okay, I'm happy to take that. Look, I think a general sort of definition is an impact investment is an investment into a company that has a pathway to produce social good as well. So the difference is, I think it's sort of a little bit of an apples to oranges comparison. You could get on an angel network and you could see a high impact deal there and say that, hey, I really believe in this company and I want to write $100,000 to them. And it's just that you don't know where you're going to see the deal. It might come to you through an entrepreneur, and he might be saying, I'm just raising a round for my technology company. And it turns out that it's actually a very high impact business, and therefore now you've become an impact investor by default. So I wouldn't say that there is like a difference per se. Some of the deals you might have already invested in if you're an angel investor. Some of the deals that you're already looking at might be like deals that classify as impact investments. And on Let's Venture, both Sachin and I are on Let's Venture, so we keep seeing deals, and we've seen so many like high impact edtech and health tech startups there that are raising funds. So who knows, you might be an impact investor already. Yeah.
Yeah, I mean, in a manner of speaking, an angel platform like Let's Venture is a platform. And deals come onto it. Now, those deals could, somebody could look at it only from a financial perspective. Somebody could look at it from a financial and a social impact perspective. I don't think the platform kind of, decides, what lens an angel investor should be looking at a particular transaction. So what Shruthi pointed out is absolutely correct. There could be deals which, people are looking at from different perspectives. But I think Let's Venture also, there has been a great interest from what I understand from Anshul, people like you on angel investors wanting to look at deals which have a balance between financial return and impact or social return, which is great to hear, and which is exactly what I think will drive the angel investing market, the early stage angel investing market for impact. And
if I know, I hope this is right, but I think very soon there's going to be like a impact-focused deal selection as well on Let's Venture. So yeah, we look forward to that.
Definitely. I'm very sure that that is coming very soon. We'll let all of you know about that as well, so that we can be a part of the journey of Sachin and Shruthi as well. Right. So Shruthi, I would like to ask you, just to add on to this question, are non-profit organizations also eligible to make investments into impact sector?
You mean can a non-profit become an investor into an impact?
Yes.
So I think that is more around compliance. If you're registered as a certain entity, you can or cannot make investments, whether it is into an impact-focused startup or not. And I think it just depends on the kind of registration you have versus, I think a non-profit entity cannot make investments. We can check with our CS team on that. You have to be a certain kind of entity in order to make investments.
Understood. Sure. Cool. So these were the questions. We can also take one more if you guys have, like say, more 3 to 4 minutes. We can take one more last question and then we can wrap this up. Right. So in terms of, I know that we have talked about certain matrices, as Sachin mentioned, that okay, management is one of the matrix that we should definitely look out for when we are evaluating any startup into the impact sector. Can you also let us know what are the basic objective criteria or matrices that help us to measure the impact, so that it can be, say, a tiebreaker or a bonus while pitching to an impact VC maybe?
Sure. I think it's a very important question. I said what measured gets done. So if you can't measure impact, you might as well pack your bags and sort of go home if you're trying to be a successful impact investor. In my experience, it's not an easy answer, Anshul. So it's not as simple as saying I made 16% return on my investment. That's a much easier number to look at. However, there is a lot of work being done on enhancing the measurement of impact so that people can, compare it across different funds. People can compare it across social enterprises. So let me give you just one or two initial thoughts. So the first criteria, which almost all impact investors and all social enterprises use, is the number of lives impacted. That is an easy number. So if you're selling solar home systems to low-income consumers in Nigeria, if you sell 100 solar home systems and the average household size is 5, then you can roughly say 5 into 100. 500 people are impacted by the social enterprise, which is selling solar home systems. The second thing that people often look for is how many of those 500 people are the type of people which the fund or the social enterprise was trying to impact. Okay, so for example, Acumen would say people who earn less than $4 a day are the kind of people that we are trying to impact. Now, out of those 100 households, there could be 20 who are earning more than $4 a day. So Acumen's objectives have not been met with those 20 because it was trying to impact people who live on less than $4 a day. So 80 would be the number of people or households which Acumen has impacted in its target. Remember, you can be targeting girl children, you can be targeting women, you can be targeting, all sorts of different segments. And every product that goes out from you might not reach the beneficiary you were targeting. And therefore, you have to be conscious of that. That number is slightly harder to measure, but it can be measured. So one is called the number of lives impacted, and one is called how deeply targeted are you on the segment you were trying to impact. So those are two numbers. The third, which is very, very critical, is how much difference did you make to the life of the people that you were trying to provide the product to. This is often what is called the depth of impact. So I provided a solar home system to a household. What happened? Did they use it? Did it make a difference to their lives? And so on and so forth. And there are studies which have been done by the World Bank on how much carbon dioxide emission is reduced in the household because of a solar home system and all of those sorts of things. But an interesting way to do it, which we often forget about, is ask the consumer. Go to the consumer and, ask them, like, what difference has this made to the life of your family? Because earlier when the sun went down at 6 o'clock in the evening, there was no light in the house except for kerosene lanterns or something like that. Now you've got a solar home system. And just as an anecdote, when Acumen did some of this work, the men and the women had different answers to solar home systems, which are these solar lights in your household. The women, the number one thing that they liked about the solar home system was safety. Because they felt that if there was light in their house, they just felt safer. If they had to go to the kitchen, which sometimes is outside the house, they just felt safer because they could see what was happening over there. The second thing that they loved was that they could make the kids do more homework. Because otherwise the kids used to stay at 6 o'clock. Now it's dark, we can't do any homework. With the solar home system, they could do homework till 7 or 7:30. And many of the consumers articulated this, and they even articulated how much they would be willing to pay to keep the solar home system, which actually added a monetary value to the improvement in the quality of life. So lots of work happening, but I think width of impact, targeting of the consumer, and some feedback on how has this changed the life of a family, can actually be put into metrics, which can be reported, which can be collected, which make a big difference to investors. Because if they are looking to have impact through their investments, then they want to know what difference has it made to how many people.
Got it, got it, got it. Thank you so much. I'm very sure that this might be a very starting point for all of us where we try to understand how to measure impact by just learning from the feedback that we are getting from the customers themselves. Right. So yes. So again, Dipti has a question that says, "What was the reaction of the men you missed that?"
So for men, the number one reaction was actually productive use. They said that they could keep their shops open longer. They could do those sorts of things. So they were actually thinking of the income earned because there was light for 3 to 4 hours longer than before. So it wasn't very nefarious. It was actually also pretty nice that they were trying to make more money for their families using the light which was now available.
Thank you, Sachin, and thank you, Dipti, for reminding us that we forgot to mention the reaction of men. Cool. Thank you. So this was it, guys. If you have any other questions, we would really like all of you. So you can just write back to us on our email, and we would definitely make sure that we answer all of your questions with the help of Shruthi and Sachin. And we hope that this was really helpful, because it was definitely very, very insightful for me and for all of us that we are here. So thank you so much, Sachin and Shruthi, for taking out this time and helping us understand more about impact investing as a sector in India. Right. So great. Thank you all of us for joining us this evening, and we would come up with some such AMA sessions for all of you. So don't forget to join in and start learning about angel investments.
Thank you. It was a pleasure to be here. Appreciate it.
Bye.
Thank you. Bye-bye.